this last presentation regarding behavioral finance and how to bring your best instincts to your financial plan. It's my pleasure to introduce Heather C. Liston. Heather is a certified financial planner and the principal of a fiduciary-based firm in San Francisco. She holds the IRS's enrolled agent certification as evidence of her expertise in income tax planning. Heather graduated from Princeton University and earned a master's in accounting at NYU Graduate School of Business, as well as a certificate in personal financial planning from UC Berkeley. She has taught income tax, retirement planning, and other subjects at UC Berkeley, UC Santa Cruz, and Golden Gate University. She frequently speaks to groups including the National Association of Realtors, SF Village, and the SF Public Library. Well, please do me a warm welcome of Heather C. Liston.
Thank you. Thanks very much. And did you notice he didn't say without further ado? Almost everyone says without further ado, so good work. Okay, you can all hear me, right? All right, great. Thank you so much for coming. I know it's the end of the day and you're probably tired. There's a lot going on. It's been an exciting day, but I'm so glad you made it. And personally, I think this is the most fun topic in financial planning. So I hope that you will find it that way too. We're going to talk about a discipline called behavioral economics, or sometimes people call it behavioral finance. What's so interesting about this is it's essentially where finance meets psychology. And what it is a recognition that we are not all rational all the time. You probably knew that personally, but you probably didn't know that applies to everyone else as well. So behavioral economics is the study of psychology as it relates to economic decision making. And the two most important questions in this field, as I wrote, are economists' assumptions of utility or profit maximization good approximation of real people's behavior? And do individuals maximize subjective expected utility? That may already sound like a fair amount of jargon. So I'll just tell you, in economics, utility and happiness are kind of interchangeable terms. So what it essentially means is, do we always make financial decisions that lead to the ultimate happiness for us? And the answer is we really don't much of the time. But because humans are somewhat consistent, we can actually get a handle on it. And we can figure out, okay, my instincts are not leading me to the right, most rational decision. How can I manage that? So Richard Thaler, the man whose name is at the bottom of this, wrote a good book called Misbehaving. He also won the Nobel-prize in economics a few years ago for his work in behavioral finance. That helped really make this field come forward. The fact that he won a Nobel-prize, that's a big deal. It means the economics profession worldwide realized this is an important topic. So he says that economists sort of made up this ideal of a human being, and he calls that person an econ. That's the kind of person you study in an economics class in college, who always figures out what's the expected return of an investment and buys the one with the best expected return, the person who makes all the most logical decisions. But he said we really don't always behave that way. And so he posits there's this other thing called a human, which is what we really are, and if we can figure out how humans can behave more like econs, these imaginary beings, or how we can get econs to understand their human side, we can start making more realistic predictions and better decisions. The reason we study this field is that knowledge is power. That even if we are still subject to things that are not entirely rational, to the extent that we can understand that and be aware of it, we can make better decisions. So we have many areas of this I want to go through. I feel like I missed some slides. Yeah, I did. Okay. So this is important. You've probably heard this before. I'm going to give you general examples. These are not specific recommendations about your life. If you have a CPA, a lawyer, a financial planner, by all means run these ideas by them. And please don't sue the public library. They're doing a great job. And then this is an overview of some things I want to talk about, various topics that are related to behavioral economics, including spending, anchoring, that's a specific term related to this field, saving, retirement planning, investing, taxes, and you'll notice the last one is laziness. I'm here in praise of laziness. Very often, this is a great thing, very often in financial planning and investing, the easy way is the best way. Sometimes clients will come to me, particularly clients of a certain gender. Let's just say men are more likely to do this. They'll come to me and they'll say, I've been studying the stock market, I think I have it all figured out, but I'm not going to invest anything until I understand the whole stock market. That's a guy who's never going to get anything done, and he's going to be missing out on some returns along the way, because the fact is nobody ever understands the whole stock market. Nobody ever understands all of anything, and yet there are steps we can take that don't require immense thinking that can put us in a better position. So, first of all, I would ask you to think, is there any time when you make a decision that is not entirely rational or that doesn't always lead to the best outcome? When I think about that for myself, cookies come to mind. I know cookies aren't good for me. Sometimes I eat them anyway. Very easy to do, right? That's a very human decision. Oh, that cookie looks good, even though I promised myself. So we all do that in all kinds of areas. And again, the more I think about it, the more I might try to keep cookies out of my field of vision, the better position I'm going to be in. So let's think about that in terms of spending. One of the really places where behavioral finance and psychology come into spending decisions is, how do we figure out what's the right price for something? There's not really any absolute way to figure out what's the right price for something, right? So we make these decisions based on a few heuristics. One is relativity. We can say, well, this orange costs $4. I know the store across the street sells it for $1. That's a pretty easy decision, right? Assuming the orange is just as good, we might as well get the cheaper one. But what if we say this orange costs $4 and this coffee cake costs $1? Is the orange a good deal? It's kind of a tough decision, right? You got to think about things besides just which one actually costs less. So this is a sort of famous example, the Economist ad that I'm going to show you. But meanwhile, studies have showed, and behavioral finance people do a lot of really fun studies. They find that given a range of choices, people often buy the second most expensive thing. So they often buy the second most expensive dish on the menu. Or the reason I noted rollerblades is many years ago, I don't know if you're old enough to remember when rollerblades were a big fad, but the rollerblade company offered 4 models. The most expensive one was quite expensive. I think it was over $300, and this is in the 90s. Had a lot of almost literal bells and whistles. There was a lot of stuff on that you didn't need. Then there was the cheapest model, the next cheapest model. The second best model was the one almost everyone bought. It cost about $200. Those are the ones I still have under my bed disintegrating, but they were really, really fun while they lasted. It was a great model. It worked really well. It was much better than the less expensive ones, and I didn't need any of the fancy stuff on the most expensive one. So I made that decision to buy the second most expensive of 4. I was very happy with it, and the salesman told me, yeah, that's what everybody buys. Now, if there wasn't that most expensive one, not everybody would buy that second one because it would feel expensive. So given 3 choices, most people choose the middle. And so this is a famous study that someone did. It looks like it's just an ad for the Economist magazine, which it is. It is a real advertisement for the Economist magazine. But it was kind of put together by a behavioral economist named Dan Ariely. He's one of the big names in this field, because he was doing a study. So you'll notice if you buy just the online subscription to The Economist, it costs $59. If you buy just the print subscription, it costs $125. If you buy the print and web subscriptions together, it costs $125. So which one do you buy? Would anyone buy the middle one, the print subscription only for $125? That would be dumb, right? Because to have that plus the web subscription doesn't cost any extra. So in fact, nobody's going to buy that middle one. So why is it even on the list? The reason it's on the list is because you feel really smart when you buy the one at the bottom. I was going to say most expensive, but it's not more expensive. You feel really smart when you buy that, because it's the same price as the middle one, and you get more for it. So people went to the trouble to put together this ad knowing that no one was going to buy that middle one. But when they ran the same ad without that middle option, most people bought the bottom one, the web thing only, for $59. That is less than half the price of the double thing, and some people might have said that's worth it. And they don't have that middle one to kind of make them feel like they're making a good decision. So speaking of relativity, H.L. Mencken, who you may have heard of, he's the old journalist from Baltimore, a famous curmudgeon, he said, a man's satisfaction with his salary depends on whether he makes more than his wife's sister's husband, which is probably pretty true. If you think about this in your own life, it's hard to anchor, right? Like, what's the right salary? I can remember a time not long ago where I was very impressed if I heard anyone made more than $100,000. That sounded like a very big number. As you may know right now, if you live in the Bay Area and you make $100,000, you're not doing that great. That is not a high salary here. It would still be a high salary somewhere else in the country, but not here. So what is a good salary here? Is $500,000 good? Is $1 million good? Who knows? But if you happen to know what your friends and family are making, and you know you're doing better than them, that feels pretty good, right? Or if your company makes salaries public, and by the way, if you work for a nonprofit organization, that's public information, what people are making, you can look it up. And if you realize, oh, I'm the second highest paid person in the company, that feels pretty good. Even if it's a nonprofit and your salary is pretty low, you still know, hey, my company values me. So we are always looking for something to compare to. Other studies have shown that we feel good if we have the nicest house on the block, or the nicest house on the street. You don't need to have the nicest house in the world to feel good about yourself. But if your house is better than your neighbor's, studies show you feel pretty good about that. One kind of interesting side note about that, someone did a study years ago about why consumerism became kind of turbocharged in the 80s and 90s and beyond. And one theory they came up with was when there were all these sitcoms on television, with families that are living sort of in ways that look ridiculously comfortable. All of a sudden that made people feel like, oh, those are my neighbors. Like, I know the Brady Bunch. How can the Brady Bunch have 6 kids, a dad who stays home all day, a maid, and bedrooms for everybody? And so all of a sudden we were comparing ourselves to families that aren't even real, right? We see things that aren't even real and we think, I'm not doing that well. Or if you remember when Harry met Sally, I don't even remember what Sally's job was, but she was a fresh college graduate living in Manhattan. She has this gorgeous apartment, with glass on 3 sides. I remember I lived in New York at the time, and my mother called me and said, why can't you get a nice apartment like that? And I said, because that's not real. A recent college graduate with no savings in New York City is going to be living in the basement in one room with a toilet in the hallway. That's what's real. But we compare ourselves to these other things and we think, oh, I'm not doing very well. So it is important when you're thinking about yourself to try once in a while to disconnect yourself from those anchors or to find more appropriate ones. Like, let's say you're working for a nonprofit, you're doing very good work, you're earning enough money to get by, but your neighbor works for Google or Meta and they're earning a ridiculous amount of money. Maybe you don't necessarily want to compare yourselves to them. You may want to think, I'm making a very good salary within my field. It's not the same field as those other people. So the more you can think about that and be aware of it, maybe the less you can feel bad about things. Anchoring. I've already used this word anchoring, but I haven't really defined it yet. Anchoring refers to the fact that we don't know how much something should cost. Should that orange cost $4 or should it cost $1? How do we know? So we anchor based on various things. And by the way, the reason I mentioned a $4 orange is I did pay that recently. There's this wonderful brand of orange or variety called Sumo oranges. They're absolutely delicious, but they're also really expensive. And the first time that I bought a bag of them, I thought the supermarket had made a mistake. I saved my sales slip because it was so expensive. And I went back, but it turned out they had charged the right price. And then I had to try to figure out for the future, is it worth paying $4 for an orange? And it depends on what you're comparing it to. It's very healthy, it's very good, and I can afford it. So I ultimately decided I'll keep doing that. But I was anchoring based on various things. One is I was thinking, wow, I used to buy oranges for, 69 cents. So I was comparing it somewhat unrealistically to earlier prices of oranges. You can also compare it to a lesser brand of orange, but you're comparing it to something in your mind, whether you know it or not. So you may be aware that when you go to a car lot, you'll see the manufacturer's suggested retail price, the MSRP. Nobody pays the MSRP, right? That number that's advertised in the window of the car, on the car lot, that's there so that you feel good about the price that you do pay. It will say something like manufacturer's suggested retail price $80,000 for this new car. Then you talk to a guy, the salesman comes around, he takes you in the back room, he tells you he's trying to make his quota this month and his manager owes him a favor, yada, 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 comes up with it and says you'll pay $74,000. You feel great because you feel like you got an $80,000 car for $74,000. And that is why they put $80,000 on the window, so that you would have something to anchor. So you would say, well, it's supposed to be $80,000. I think I got a deal. Instead of saying, what do you mean $74,000? My last car cost $8,000. They don't want you anchoring against that. So they give you this other number to anchor to. Now, very often we go to a store and we see something marked down, right? I love things on sale. 10% off, 20% off, whatever. That feels really good. And so the store won't just put a new tag on it, of course. They'll cross out the old price and say, was $89, now $49. You feel great. And you anchor that way. This particular label, and I think this one is from something at Nordstrom's Rack, so it's a discount store. And most of the stuff they sell is not extremely high quality and it's not very high priced. So it's fair enough. But you'll notice it doesn't say original price $29.99, right? It says compare, or it doesn't say original price $45. It says compare at $45. What does that mean? Nothing. It doesn't mean anyone ever offered it for $45. It just means they want you to think, this could cost $45, but you're going to sell it to me for $29. That's nice. And they are allowed to write compare at $45 because it's meaningless. If they said original price $80 or $45 and they had never offered it at that price, that would actually be illegal. But they can say this meaningless phrase, compare at. So how do we anchor all these things? I have a lot of apps on my phone that are free. So if someone asks me to pay 99 cents for an app, I often skip it, right? Don't you too? You're like, they're supposed to be free. But somebody put a lot of work into it. Should they be free? I don't know. I'm just used to paying $0 for them, so I like to pay $0 for them. When it comes to big things like paintings, it's even harder. How do you know if a painting's worth $1 million or $10 million? We don't have much to go on for that. So that would be a difficult decision. Very often, as we said, the most expensive item on a menu is just there to increase the sales of the second highest item. So imagine you go into a nice restaurant, maybe you're with friends, you're treating them to dinner, you want the whole evening to be very pleasant. There's a wine list where most wines are somewhere between $15 and $25, and there's one bottle for $89. Would you buy that one? What about now? What about most wines are 15 to 25? One of them that sounds really nice is 89, and there's another one that's $450. Who would buy the $450 wine? Some people might, showing off, right? And then they'd bill it to their company or something. They'd find a way to pass it along. Who would buy the $89 wine in this situation? You might, on a special occasion, right? Partly because you'd look at it and you'd say, oh, that's the middle price. It's not the high price, it's the middle price. And in fact, it's less than a quarter of the most expensive wine. So all of a sudden, $89 just feels more reasonable. So the restaurant with this menu, they know nobody's buying that $450 wine, but it means more people will buy the $89 wine. So again, it's not illegal, it's not even immoral really, it's just something to be aware of, that you might want to have a different anchor in your head. Like maybe before you go into the restaurant, you think, I'm not going to pay more than $60 for a bottle of wine. Maybe you kind of make up your own anchors. Or you think, what does the good wines go for in other places? So that your mind doesn't just play the tricks that everybody's mind plays. By the way, people who choose the $89 bottle here and not on the previous slide, they're not dumb people. This is a very normal human reaction. And that's why we want to be aware of it, so that we can fight against it if necessary. If you want to buy an $89 bottle of wine and you can afford it, have a great time, no judgment. But if you're feeling sort of pressured to because you'd feel cheap if you bought one of the other ones, then think about it. Think, what's really a reasonable price for wine? And maybe try to come up with your own anchor. Maybe your own anchor is, how much would I pay for this wine if I bought it at home? Or, how much do I pay for my favorite kind of wine under normal circumstances? Is this reasonable in those contexts? So you bring your own context to it. Next issue, saving, and how to do more of it, and feel good about it. Dan Ariely is a name I've mentioned before. He is a famous behavioral economist at Duke University, and he runs an institute called I think it's called the Institute for, oh, now I'm going to get it wrong, Institute for some kind of hindsight. Anyway, for perfect hindsight or something like that. He does a lot of really fun studies, and he writes very accessible books. At the end of this presentation, I'm going to show you my favorite books in case you want to read more about it. Jeff Kreisler is a comedian. The two of them wrote this particular book together called Dollars and Cents. And they said, think about a future you. That's you, but later. And ask her, would she be glad if you had saved more? And think about then, who needs the money more? If you're just barely getting by, maybe you need to spend some money now to get a decent apartment or a decent meal. Maybe you really can't be saving right now. But if you're kind of spending money that you don't need to be spending now, realizing that this future you is never going to be able to retire, that's something to think about. So see if you can compare those two things. And that reminded me when I read that book of this Seinfeld routine where he says, I stay up late because I'm night guy. Getting up after 5 hours of sleep, I don't care. That's morning guy's problem. So he's thinking of himself as two different people and coming up with probably not a great decision. Interestingly, as I said, there's lots of really fascinating research in this field. This particular study was done by Keith Chen, who is a linguist and a professor of economics at UCLA. He did a study on the savings rate in various countries and compared it to their language structure, and he found that countries that do not have a future tense save, let's see, if your language has a future tense, it's harder to save. Okay, so English has a future tense, right? I will do this later, I do this now. Chinese does not have a future tense. So he says that that's one reason it's hard for Americans to save, because when we talk in the future tense, we think of that other person in the future as kind of a different person. I'm not sure if this is true, but I found it fascinating. And I learned about it from a TED Talk. And by the way, you will have access to these slides later if you want, and you'll notice there's a link there. If you want to look for Keith Chen and hear him tell the story, it's very interesting. Okay, next topic is retirement planning. Probably a big topic for all of us. It's a big topic for all financial planners. And you'll notice the subtitle I put here is Facilitate Inertia. As I said, very often the best decision to make in financial planning and in saving and investing is the easiest one. Saving for retirement is hard if you think about it a lot, but if you set it on automatic and ignore it, it's not really very hard. So most of us these days have a retirement account through our job, very often a 401k, sometimes a 403b, a 457, or a TSP. I see people in this room right now who have all those kinds of things. They're all great. And they're all pretty similar in the way that they work. So why doesn't everybody maximize the savings available to them in the 401k? One reason is inertia. They just don't get around to it, right? You start a new job, you have to fill out a big pile of paperwork, you got to bring in your Social Security card, yada, yada, your proof of citizenship, and then you've got this paperwork about joining the 401k. It's just easier not to. That's one reason people don't get around to doing it. Another reason is loss aversion. Loss aversion is a very big topic in behavioral finance. Loss aversion means we hate feeling like we lose money. And so with a retirement savings plan, really, ideally, you're saving money, you're going to be way better off in the future. But sometimes people feel like it's a loss right now. If they say, oh, my take-home pay is $100 a week now, if I start putting $20 into this retirement plan, my take-home pay is only going to be $84 a week. Now, you may be thinking she did the math wrong, but I didn't, okay? I said you're taking home $100 now. If you put $20 in, you'll be taking home around $84. Now, that's a very rough estimate, but what you notice is I didn't say $80. The reason I didn't say $80 and do the simple math is because when you start putting money in that pre-tax retirement account, your taxes go down. So your paycheck does not go down by the full amount that you're putting into your savings, which is one reason it's great to do the savings. But still, for some people, they think, oh, I was taking home $100, now I'm taking home $84? That felt like I lost money. Now, you didn't, of course, because it's still your money, and you're saving it in a better way. But it's one reason people don't get around to it. Another reason, as Richard Thaler says, is self-control. We have more self-control in the future than we do in the present, or we think we do. Another quote from Richard Thaler, more about inertia. He says, surveys reveal that most people in retirement savings plans think they should be saving more, and they plan to take action soon. It's easy to go day by day and just never get around to it, right? There's a solution to that, which is automatic enrollment. When you take a new job, used to be, you always had to go fill out a lot of paperwork to join the retirement plan. In 2006, we had a change to retirement laws. Forget what they called that particular law. There's always some name for it. But in 2006, they made a lot of changes. And based on the work of Richard Thaler and Cass Sunstein, another big name in this field, the government made it legal for your company to automatically enroll you in the retirement plan. Now, they will enroll you at a low amount, maybe 3% of your salary, and you really should be saving more than that. But they switched the inertia factor. So now, if you are automatically enrolled in your retirement plan and you don't want to save in the retirement plan, you got to go see the HR lady. I'm a former HR lady, so I know how people talk about us. You got to go see her. She's going to make you fill out paperwork to get out of the plan. So solving the inertia problem turned out not to be that difficult. More about that later. The next thing is loss aversion. We know people hate losing, and they hate seeing their paychecks go down. And he says loss aversion is measured in normal dollars. That is, people don't think about inflation when they do that. So one way to deal with that is automatic increases. So let's say you're having $20 taken out of each paycheck now. You've gotten used to taking home $84 a week. You can live with that. You've learned how to budget for that, even if you need to multiply those numbers by 100 or 1,000. But to keep it simple, let's say you got used to living on $84 a week, but you know you really should be saving more for retirement. That's a hard thing to do. But suppose you could say, next year when I get a raise, put all that raise into my retirement savings. I'm not going to miss it because I'm used to living on $84 a week. And so I can make the automatic increases each year, or maybe your raise is 3%, but you have it set so that every year 1% more gets put into your retirement account. This also became a legal and organized thing to do. And finally, self-control. A key finding from research is we have more self-control when it comes to the future than the present. The solution for that is a program called Save More Tomorrow. This was invented by, I think I have his picture here. Yeah, Shlomo Benartzi and Richard Thaler did it together, and it became real policy. They tied the increases in your saving to your pay increases, so you wouldn't even miss the money. So 2006, as I mentioned, I couldn't remember the name of it. It was called the Pension Protection Act. At that point, for the first time, companies were allowed to automatically enroll you in 401ks. Now, in 2022, the Secure Act, they've now started requiring that companies with a new 401k plan, or defined contribution plan, that's a more generic term for 401k type plans, companies that are starting new plans are required to automatically enroll new employees at 3% of their pay. That's a big change, right? And the reason that they are now required to do that is because it works out better for people. This is done from a study in 2018 and 2020. They learned that as of 2022, 51% of respondents automatically enroll new or existing employees into a plan, and that was up from 39% of companies that did that before that. 26% of companies automatically increased employee contributions. And so throughout the country, after these automatic enrollment things became law, many more people are saving their retirement plan. That's good for everybody. Okay? So the reason we have retirement plans at work is because it's good for all of us. It's good for you as an employee. It's more likely you can retire someday. It's better for your employer, partly because someday they want you to retire. They don't want you hanging around till you're 90 or 100 years old because you can't afford to leave. And we all want our friends and neighbors and family to be able to live a long and healthy life well paid for. So that's why it's worth having tax policy that benefits all of us by making retirement plans tax advantaged. So now that an automatic enrollment is a thing, as of 2022, we found that employees are saving a higher percentage of their pay and plan assets are growing faster. Now, you may be saying to yourself, and I've certainly heard this, Some people say, oh, I don't like the idea of automatic enrollment. That feels like the government looking over my shoulder. Or that feels like my employer, my company is big brother now and they're making decisions. I want to make decisions. Well, guess what? You're making a decision either way. If you have to decide to enroll in the plan, you're making a decision. If you have to decide to unenroll in the plan, you're making a decision. So both of those are decisions. So Cass Sunstein and Richard Thaler, together, they wrote a good book, a really fun book, called Nudge, or Nudge. I think either one would be appropriate. And they call themselves libertarians. So they are not in favor of big government or big corporations telling you what to do. But they define this term libertarian paternalism. Basically what they said is something is always the default. So if not enrolling in the plan is the default, and you have to come in and fill out all the paperwork to get into it, that's a barrier to entry. You're less likely to do that because it's a lot of trouble. If being enrolled automatically is the default, and you have to go into the office and fill out the paperwork to get out, that's also some trouble. And which way are you better off? You're better off being in the plan. Everybody should be saving for retirement. So you're better off being in the plan. So all they have done is switch the default to a way that works out better for you. And they say, you know, realistically, we are all lazy. Even those of us who think we are very hard workers, we can't possibly be thinking about everything all the time and dealing with all the issues in our lives at all times. We really want some things to be easy by inertia. So they say you might as well make something good the default. Another study they talk about, which is related to food, which sometimes is even easier to think about, is if you're in a cafeteria and there's a lot of delicious, beautiful salads right at eye level, and there's candy up on a high shelf, maybe you have to ask somebody to come get that for you, or there's candy in the back corner, you're likely to buy the salad. But if there's candy everywhere and you have to ask the cafeteria person to go in the back and get you a salad, you're going to buy candy because we do the easy thing, right? And either way, that cafeteria designer, either way, they are nudging you in one direction or another. So they're really not being obnoxious by putting the salads in your face, because they're going to put something in your face. So it's not that they're trying to control you one way or another, it's that they're making a default the easier way. They're making the good thing the default. Here's another concrete example of that. In the US, if you want to be an organ donor, you have to explicitly agree to it. You have to fill out paperwork, sign the forms, become an organ donor. At the time of this study, I don't remember the date on this one, but 36% of people had signed a card to be organ donors. That's because we have to opt in, and opting in takes some work. I keep making this gesture because we have to sign stuff. If you are automatically an organ donor and you have to opt out, 82% of people agree to be donors. So that means there's quite a lot of us, maybe about half the population, who just want to do whichever one is easier. We really don't feel strongly about it. We just don't feel like filling out the paperwork. And so again, if you make the better outcome the default, it doesn't prevent anybody from doing what they want. It just makes it easier to do the good thing. So as they say, I think these are quotations from Nudge, the book, it's not mandatory to stay in your retirement plan, but they say defaults are ubiquitous and powerful, and they are unavoidable. Most people just don't get around to opting. So, other terms, inertia. As you probably know if you've studied science at all, inertia, I believe, is the propensity of an object in motion to stay in motion and an object at rest to stay at rest. It's another way of saying we're basically lazy. That's not a judgment. That's a perfectly reasonable way to behave. Do the easy stuff, get the easy stuff done. You don't always want to do the hard stuff all the time. So you want to, if you are designing a retirement plan or a cafeteria or something else that affects people's well-being, you want the easy way to be the good way. Another term they use for that is status quo bias. That means we have a tendency to leave things as they are. If it takes effort to change something, we're going to leave it alone. He also, this is Richard Thaler's term, he also calls it the yeah, whatever heuristic, meaning, yeah, we'll get around to it someday. So what can you do to make good decisions about your retirement plan? You should join it. No matter how much trouble it is, you should join your retirement plan. I'm pretty sure there's no one here who wouldn't benefit from saving more for the future. And don't forget also, with your retirement plan, there are significant tax advantages. And we all have an interest in paying as little tax as legally allowable. A third reason that it's good to invest in our retirement plans is it gives us automatic dollar cost averaging. In other words, we all know we should be investing money also, but it's hard to know what's the right day to invest. In fact, we don't know. We don't want to invest the day when the market prices are the highest and they're going to go down. We want to invest when prices are low, but we don't know when that is. So people do what's called dollar cost averaging. Let's say you have $1 million to invest. You don't want to put it all in the market today. Ideally, you would set up an automatic plan where you invest a little bit each day or each week until it's all put in. So you're averaging the possible outcomes on any particular day. A 401k plan does that for you. Money is withheld from every paycheck, so you don't dump all your money in the stock market on any one day or in the bond market on any one day. You are gradually investing. So that's 3 reasons why basically I feel confident telling everyone they should be saving as much as they can in their retirement plans. Another thing that you should keep in mind, if your plan does have an automatic enrollment, that's a good thing, but it's not enough. The automatic will probably be 3% of your salary. That's not enough. You're not going to be able to retire someday on 3% of your salary. So it's a good start, but you should increase it. Don't just accept that default. Now, that will probably be pretty easy. It will be easier to increase that than to go in and fill out all the basic paperwork from the beginning. But try, if at all possible, to put the maximum amount allowable by law in your retirement account. How much that is? If you are under 50 in 2025, it's $23,500. If you are over 50, it's $31,000 in 2025. Now, if you work for a low-ish salary and you're glazing over thinking, why is she talking about such big numbers? I couldn't possibly afford $31,000. Don't panic. Do as much as you can. Put in as much as you can in your savings account up to $31,000 because you will get a tax advantage, you'll get good investments, and you will someday be able to retire. So don't just accept the default, increase it. If you're designing or managing a retirement plan, build in the nudges that are good for your employers. Be aware that people are going to be doing what's easy, so make it easy for yourself to save. So one of the things I want to stress here is we don't beat ourselves up and say, oh, I know I should have joined before. Behavioral finance is about being realistic. It's about recognizing human beings don't always think rationally. We don't always have the energy to do the best possible thing or the information to do the best possible thing, and that's okay. We need to do the best we can with the information available, and we need to make things easy so that it's not a big effort to be saving all the time. Next issue, investing. I know some of you went to the investments seminar this morning. I wish I'd been able to go. Those are very smart people. That was a great panel, and I'm so glad the people had them here. So I don't know exactly what they told you, but I bet you they talked about the beauty of mutual funds and ETFs. What those are is ways of investing in a lot of companies at once. What's good about that is we have no idea what's the best company to invest in right now. I'm an investment professional, and I will tell you outright, I have no idea what's the best company to invest in. Nor does anybody, no matter how much they charge you to invest for you, they really don't know. They know what did well yesterday, and that's interesting information, right? We know what stocks were up on Friday, but we don't know what stocks are going to be up on Monday. And that's really all that matters. And so that's why it's usually prudent not to bet on any one company and not to say, boy, I got to keep studying all these charts. I got to figure out, I got to understand the stock market before I invest. You really don't. Just make it easy for yourself. Just buy mutual funds, which get you into a whole lot of stocks at once. And then if the economy in general is doing well, so do you. Oh, so I meant to actually ask you this, even though I gave you a preview. What's the best advice about investing that everybody knows? It's this: buy low, sell high. Remember? You've probably heard that. Buy low, sell high. Is that what you feel like doing? The answer is no. If you're a normal human being, you really feel like doing the opposite. You really, really feel like it. When you wake up in the morning and you Google whatever you do to look at how the stock market is doing, dowjones.com or big charts or wherever you look, or maybe you log into your own accounts at Fidelity and you see, oh, everything's down. If you're seeing the stock market is lower than it was yesterday, the normal human reaction is to think, oh no, I don't want to invest. That looks terrible. If you look at the stock market at the top of a peak, you're going to say, wow, that's going gangbusters. That's fantastic. I want to be in the stock market. Let's put all our money in. So this is very, very normal. We all have the wrong instinct about this. I just made a blanket statement. We all have the wrong instinct. You may argue that you can outthink it, but I'm going to still say the instinct is universal. We feel like buying high and selling low, which is the opposite of what we should do, which is why the laziness factor comes in. The less you pay attention to the stock market, the better you will do, which I love. It means we can be lazy. So I have a few examples here from real client situations. I worked with a couple. I changed their names, of course. But let's say they were Deb and Doug. They had about $4 million altogether. $2 million of it was in cash. And I wanted them to start getting that money invested. They didn't need $2 million in cash. This was a couple of years ago when cash was earning nothing. You could get maybe 0.5%. Right now, you can get 3 or 4% if you invest your cash wisely. It's not quite as bad. But at that point, I wanted their money to be working for them. I didn't want them to put all $2 million into the market on one day, because it might not be a good day for it. So we made a plan. We made a plan to gradually invest that $2 million every week, X dollars into various funds. Now, the best thing to do if you're doing that is set it up so it's automatically invested. Vanguard or Schwab or Fidelity or E-Trade, all those places, you can set it up in advance. Say, put X dollars into these funds on these dates every week or every month. So you are not tempted to look at the news and say, oh no, don't do it today. So what happened on May 24th, 2022, they were not able to set up some of them to be automatic. So Deb said to me, that's okay, I'll treat it like it's automatic. I'll just get up every Friday and invest $10,000 in the funds you recommended. She said, I'll make it like it's automatic. But she didn't. She woke up one day on May 24th, 2022, and she said, of course, the market looked so bad the last couple of weeks, I skipped those. Now, should she have skipped buying while prices were low? No, that's when you buy low. But she didn't feel like it. It didn't feel good. So here's another one. Jan and Peter, also not their real names, they came to me because their mother was elderly. They were helping sell their mother's house, put her into a nursing home. So she needed all that cash from the sale of her house to pay her bills for the nursing home for the next few years. She got $2 million. We agreed that they were gradually going to invest, you'll notice in this case, gradually invest 20%. I wanted her to have a lot of cash because she needs that money to pay the bills. And Mom was in her 90s. We didn't have that long time frame where we know she can count on stock market growth. But I wanted them to put 20% into the market. They promised me they would, and then they said, well, of course we won't start investing now. We'll wait till the recession is over. What does the recession mean? The recession means everything's on sale. That's the right time to buy, but it doesn't feel like the right time. Let's see. Another real person with an unreal name, she was 65. Her portfolio was about 75% in stocks. There's nothing wrong with that, and she kind of liked risk. But it's a little bit of an aggressive portfolio for her person her age. Nothing wrong with it. Lots of people who are 65 do have 75% in stocks, but I just wanted to make sure she was comfortable with that. So I said, now you realize there's risk in the stock market. That 75% of your money is going to go up and down. Can you handle that? And by handle that, I meant, can you look away? That's really what I wanted her to do, is don't pay attention. And she said, well, yes, as long as I can get out of the stocks if they go down. No. Don't want her to sell when her stocks go down. That's the whole point. Final example, I was working as an HR director in 2008. Anybody old enough to remember 2008? It was a really scary time, right? Every morning you wake up and you have less money than the day before. It was really scary. I did not blame people for being afraid. I was afraid myself. But I also was old enough to know that probably there was going to be a rebound at some time, which there was. You know, if you left your money in the stock market in 2008 and 2009 during the rough times, you have a lot more money now than you did before. The market came way back up since then. But one of the employees at the company I worked for, and he wasn't the only one, he came and he said, everything's crashing, should I cash out my 401k? That would have been a horrible decision, because he was not 59 and a half years old. If he cashed out his 401k, he'd pay full income tax that year on all that money. He'd pay a 10% penalty to the federal government and a 2.5% penalty to California for early withdrawal, and he would sell everything at rock bottom prices. So the answer was no. It was a time to get in, not to get out, and yet I understood his feelings. So that really is how people think, no matter how many times their financial advisors tell them to buy low, be consistent, and hold for the long term. And so that's one reason, actually, when people say, well, why should I pay a financial advisor? You don't have to pay a financial advisor. You can do your own investing. But one of the reasons that people hire a financial advisor is to stop them from making dumb moves. Because we all have that inclination, oh no, it crashed, I want to sell. If you have a steady advisor who can tell you, nope, this has happened before, stay calm, we have an emergency fund, you have enough money that's not in the stock market, so you don't have to sell at a bad time. A lot of times that's the best thing an advisor can do for you, is stop you from taking action. So this is another fun story, and this is partly, I'm not sure if this study is entirely true, but I found a few people talking about it. So this is from a Business Insider article. One guy says to the other, Fidelity did a study about which accounts had done best at Fidelity. And what they found was, the other person guessed, those people were dead. And there is a story about that, but I'm not sure it's true, that they found that people were dead and their accounts were doing the best. This person says, no, that's not exactly it, but they were the accounts of people who forgot they had an account at Fidelity. Those accounts were doing better than the people who knew they had accounts at Fidelity. So their advice is, if you want good investment performance, forget you have an account or play dead. The reason that's good to forget you have an account is if you forget, you do not panic and you don't sell at the bottom of the market. So it really is good to, first of all, if you want to make a good investment plan, first you design a reasonable portfolio with some stocks, some bonds, some cash, some US, some international. You design a reasonable portfolio with a lot of diversification. You set it up, and then you close your computer and you go hiking, especially on days when there's crazy news. When something weird is happening in the government or somebody's putting in a new tax law or something, you turn off the computer and you ignore it, and you trust that the way you set it up is going to serve you well over the long term. Because when people sell at the bad times, which we all have a tendency to do, we seriously damage our long-term portfolios. So it's good to be dead, not really, or to forget that you have a retirement plan. Now, why is this buying low and selling high so difficult? Another reason is because we don't remember who we are. Are we a buyer or a seller? Buyers like when prices are low, right, in the regular market. Sellers like when prices are high. So would you buy this stock if somebody says it's now 20% less than yesterday, big discounts, marked down again, prices are tumbling? If this was a stock, you'd probably be worried. If this was a pair of shoes, you'd probably say, yeah, I want those. 20% less than yesterday, I want those. We love these signs, right? These are just a bunch of ads I collected. Target, Macy's, we love these, 75% off. But when the stock market does that, we do not feel so good. So buying for low prices is good. Why don't we appreciate a sale on stock? The reason is, one of the reasons is, we don't remember if we're a buyer or a seller. So you may remember this one. Even if you don't remember 2008, maybe you remember 2016. On that date in June, Great Britain voted to leave the European Union. Worldwide stock markets crashed. This is a picture of the stock market, the Dow Jones Industrial Average, on between June 23rd and June 24th. You'll notice it's not a bumpy line, it's just a cliff. The stock market just tanked. This next one is a picture of my friend Scott. That is his real name, but it's not his real picture. This is what Scott said when he saw Brexit tank things. He put this on his Facebook page. Thanks, UK, for leaving the EU and totally ruining my 401k. Now, was he right that they totally ruined his 401k? It depends on how old Scott was. If he was 75 years old and he needed to pull out a required minimum distribution, at that point, I would be feeling bad for him that he has to pull it out while it's at a low amount. But he wasn't. He was in his 40s. He had a job. So if you're in your 40s and you have a job and you're contributing to your 401k, you're putting more and more money into your 401k every week. So the fact that some of his 401k money was invested on June 24th, the day when prices were rock bottom, he bought some stuff at low prices. If he'd been selling something, that would be bad. But if he's buying something, that's good. So keep that in mind. If you are in the process of adding to your investments or contributing to your 401k, I want you to secretly feel good when you hear about stock market crashes and think, that's not my problem, I'm buying on sale. So the Dow Jones went down 3.4% in one day on June 24th that year, but in 20 years or so, when he starts selling those shares, he can actually have more money. That's just a similar one. Let's see. So what can you do? You make a plan and you stick to it. You don't change the plan because things look rough. And if necessary, hire an advisor to make you stick to your plan. So how do you know if it's the right time to invest? The answer is you don't. You have no idea. And no matter where your advisor got his or her MBA, no matter how nice their suit is, no matter how big their research team is, they don't know what's going to happen tomorrow either. They have information you don't have, and they do more research than you do, and they have a lot of mathematical models, and many of them are very hardworking and very smart. They still don't know what's going to happen tomorrow. Nobody knows what's going to happen tomorrow. So how do we know if we should get in the stock market? I love this chart. I wish it went on longer beyond 2008, but I couldn't find one that does. This is a chart showing the reasons why people don't invest in the stock market. And it's usually because it feels like a bad time. So notice, for example, 1995 and 1996. It says the Dow hits 5,000, the Dow tops 6,400. In other words, in the mid-90s, if you remember the 90s, there were some boom times then. Clinton was president, stock market was doing very well, Amazon was new, the internet boom was just beginning. People were feeling the stock market is going crazy, it must be a bubble, right? And the Dow is over 6,400 in 1996. It's never been that high in history. So we can't possibly invest now, it's got to be the peak forever. Anybody know what the Dow closed at yesterday? No. 46,000, wow, very good. I don't know how you did that. 46,000 yesterday. So if you had invested in 1996, would that be a bad decision? No, that'd be a great decision. Now, what I don't know is tomorrow will the Dow close at 40,000 or will it close at 80,000? Probably neither. But in 10 to 20 years, I bet it's going to be higher than 46,000. So none of these are really a great reason, even though they really do feel like a good reason at the time. Look at 1946, the Dow topped 20. And people said, ooh, it's too high, it's over 20. Now it's over 46,000. So you want to be on that ride, even though any particular moment, every one of these things is real, right? The Suez crisis, the 2008 liquidity crisis, as I said, I'm going to acknowledge that was a really scary time. You may remember Y2K. You remember right after 9/11, 2001, the world economy was scary. But the fact is, over the long run, here's what it looks like. 1934, we were still in the Depression. It was really scary. People didn't have a lot of money to invest. But if you put money in the stock market in 1934, this is what would happen over time. That's a ride you want to be on, right? And you'll notice when you look at this perspective, this is about 90 years, the little blips along the way hardly even matter. Like, look at 2008. If we look around 2008, I guess it's better if I stay here. Around 2008 and 2009, we do see a downturn, right? But you may remember that as much more catastrophic. It was very scary at the time. It was a huge downturn compared to the year before. But compared to the big picture, the long run, it's just a little dip. And that is very often how things look over the long run. Over the long run, this is a pretty picture, up, 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 up. The little things along the way are scary, but they don't last. Another one I want to draw your attention to is see if you can find 2020 on that graph. There is a dip in 2020. And you may remember why. Around March of 2020, we suddenly realized this pandemic thing is real. And this pandemic is like ruining the supply chains, right? It's ruining everything. There's container ships sitting out in the bay that can't get anywhere. We can't buy stuff. We can't go to the store. The restaurant's closed. It was real. And it did throw the worldwide economy for a loop. And at that point, even as a well-trained financial advisor, I thought, oh my God, I was wrong. I thought, I have been telling people, stick with the stock market for the long run, but I didn't think of a pandemic. I thought, I was wrong. I should never have told people to trust the law. Yes, I should. Look how relevant it looks now. Really not a big deal. The stock market seems to be amazingly resilient. Real things happen that cause real problems, and in the short term, they're bad. Like if you suddenly had to sell all your stocks in March of 2020, you would have lost a lot of money. But if you are able to hold on and stick it out, there is no need to panic. So that's why we want to fight against our instinct to panic. And the ways we can do that are we invest in mutual funds and ETFs, so we don't worry about any particular stock. We keep enough money out of the stock market so that we don't have to sell at a bad time. Like we have enough in bonds or cash or savings accounts or CDs so that if we need to pay a big bill, we don't have to sell stocks at the bad moment. So that's called diversification. We have different money in different places, so we're not at the mercy of the market, but we trust in the long term, we don't panic, we don't overreact, even though it's perfectly human to overreact. This is not exactly the same chart, but it does get us a little farther up. You'll notice in the 2020s here, we see coronavirus, inflation, war in Ukraine, war in Middle East. Those are all serious things. They matter, and yet the stock market still goes up. Okay, so how do you invest your retirement plan? You need to make sure you invest it. You don't want to just put the money in and then have it sit around and do nothing. You want to invest it. So I find this very interesting. Sheena Iyengar, and by the way, I may have mentioned at the beginning, this is the most fun part of financial planning, behavioral finance. So I'm going to recommend several books. This is one of them. Her book is called The Art of Choosing. She also has a really good TED Talk about this that I think you will enjoy. She's done some really fun studies about how people make choices. And she says, she did a study and found that one of the main reasons people do not sign up for their retirement plan at work is there's too many choices. And I can tell you as a former HR director, and that I was doing it before the days of automatic enrollment, so I would have people come into my office, I'd tell them you really need to sign up for the retirement plan. They'd get through all the paperwork, and then I say, okay, now choose your investment funds. And they say, oh, I don't know, I better go ask my wife. And then they never come back. It's difficult because they don't know what to choose. Nobody knows what to choose. I don't know what to choose. Nobody knows. So she found that for every 10 more investment choices added to a plan, participation rates went down by 2%. So that's kind of fascinating, right? We think that we like choice, but we really don't like choice as much as we think we do. We really would like somebody to make it a little easier for us. Now, when I was an HR director, I was not allowed by law to tell people what were the best funds to be in, partly because I don't know, right? And if I was giving people investment advice when that wasn't my job, that would be inappropriate. But sometimes if they cried, I told them anyway. And that has gotten easier now because there are these things called lifestyle funds and target date funds, okay? Those, and many companies have some version of that. Fidelity has Fidelity Freedom Funds. It's the same thing. What that is somebody else is deciding for you a mix of stocks and bonds and international and U.S. So you don't have to say, I need X dollars of my money in a stock fund and X dollars in this kind of fund. You can just say, let's put all my retirement money into the 2050 Freedom Fund or the 2040 Target Date Fund. What you do is you say, I think I'm going to retire around 2040. Let's just put my money in that fund. And then somebody else will say, somebody at Fidelity or Schwab or Principal or Empower, wherever your retirement plan is, somebody else is thinking, here's a good mix of investments for somebody about that age. So if you are having trouble making a decision, just choose one of these and be done with it, because it is better to do something than nothing. And if you maybe have an investment advisor or you have an aunt who's really good at this and you want to get her opinion and make decisions, totally fine. You go ahead and do this anyway so that you're signed up on the first day. Put your money in the lifestyle or target date fund. Then go talk to your expert, and if they tell you to move it around, you can move it around. No problem. But what I don't want you to do is be paralyzed and do nothing because it's too hard to decide what to invest in. So go ahead and invest. Do it the easy way. The easy way is fine. I think that's really good news, that the easy way is fine. So taxes, also something that we don't always make rational decisions about. So I'm going to tell you about two real-life clients. These are not their real pictures or their real names, but they both are people who didn't take my advice, and that's okay. I am, by the way, in my private life, I'm what's called an advice-only planner. It's a model that a number of people you may have met today do. It means we don't invest your money for you, we just tell you what to do. And then if you don't want to do what we tell you, That's okay, it's your decision. So Roger owned a business. He had very high income. He and his wife owned the business together. They're in a very high tax bracket, and they expect to retire in a few years. So when it comes to retirement plans, and I'll come back to the other one, I recommended that he maximize all his pre-tax opportunities right now, that he put the whole $31,000 into the pre-tax retirement account, and that he also do various other things, all pre-tax, because I wanted to lower his income tax now while he's in the high bracket. In a few years, he's going to retire. He'll be in a much lower tax bracket. He can start taking that money out. So I said, put it all into pre-tax. He listened to a radio talk show. Actually, this was a few years ago. Now it would have been a podcast or a YouTube. But he listened to that talk show, and the person said, Roths are great. Quick reminder, a Roth account is one where you put retirement money in it now. You don't get a tax break now, but over the long run, it grows completely tax-free. So you never pay taxes on the interest, the dividends, the capital gains. No matter how long you live, for the rest of your life, your Roth money is never taxed again. It's an incredibly good deal in the long run, but you don't get a tax break now. I wanted Roger to have a tax break now when he needed it most. But he said, nope, I heard Roths are the best thing to do. So he maximized all his Roth savings this year. He also converted all his old pre-tax money into Roth accounts and paid taxes at the highest possible rates right now. I didn't advise that, but it made him happy because he'll never pay taxes on that retirement money again. Now, Marisol is kind of the opposite. She's a freelance musician. She doesn't make much money, but she's very talented, and I think she's going to make money in the future. She's young. She expects a higher income in the future. Also, her income is very uncertain, and she's many years from retirement. So I told her, put your current retirement savings into a Roth IRA, because she's not in a high tax bracket now. She doesn't need the tax savings now. But if she puts that money in now, and she's young, it's going to grow tax-free for a long time. It's going to be a great deal. And later, I have every hope Marisol's going to get a good job. She's going to make a lot of money as a musician. She's going to be in a higher tax bracket, and it won't matter because she's got all this tax-free money growing. She said no. She said, I hate paying taxes. I don't want to pay 1 penny more than I have to right now. I'm putting my money in pre-tax right now, even though she wasn't saving very much money because she was in a very low tax bracket right now. So maybe I shouldn't even tell you they didn't listen to me. I think my point here about this, though, is that I told them the rational decision, the one that had the most expected utility over the long run, and the one that could help each person pay the least possible taxes over the long run. They both had strong emotional feelings that overrode that. They have every right to do that, but I would just like you to be kind of aware about your emotions and make sure that you're making a reasonable decision. And I think we're getting near the end of our allotted time, and I want to make sure there's time for questions, so I might go a little faster. But I think behavior is everything, right? If I tell you the right thing to do and you don't do it, so what? Nobody got anywhere. So that's why I want you to be aware of your emotions and maybe think about it, about why you're making the decisions you are. If your advisor tells you something and it doesn't sit right to you, ask someone else. It's fine to get multiple opinions. Maybe if 10 people told Marisol to invest in a Roth, she would have. Maybe it would start to sink in. So it's fine to ask for help. But if you have a plan, remember that the plan is for the long run. The plan is so you do what makes sense and then you stick with it. You don't say, oh yeah, but the market crashed, I want to sell everything. Remember that your plan is for the tough times. It's not for the good times. I want you to own your irrationality. Don't keep saying, yeah, I'm smarter than that. I'm not going to make those mistakes. I'm smarter than that. Accept that we all have emotions and see if you can find ways to work around that and embrace your laziness. How do we embrace it? We sign up for auto-enrollment, automatic investing. We save more tomorrow. If a decision is hard, like how to choose investment funds, we find a simple solution like a target date fund, and we say, I'll deal with it later. These are some other nudges to consider in your own life. The second one you probably have heard of. Some people, if they buy things when they shouldn't, some people are sort of addicted to home shopping or something, they freeze their credit cards in a block of ice. By the time it's melted, maybe the whim has passed. These are things I've heard. You can get a cookie jar with a lock that won't release the lock until an hour or a day has gone by. That one about not walking by the vending machines, that's from this book I read. Charles Duhigg wrote a good book, you may have read it, called The Power of Habit. He describes in there how he was working at a job and he found he was gaining weight. And he wasn't quite sure why. He realized he had a big cookie, I think, every afternoon at work. So he gave some thought to that. Why was he eating cookies at work? Was he really that hungry? The answer is no, he wasn't hungry, he was lonely. So every afternoon he'd get bored and lonely, he'd walk over to see his colleagues, and his colleagues had a desk near the vending machine. So he devised a new walk for himself that didn't go by the vending machine. Now, I think a lot of us will say, boy, I have better willpower than that. Maybe you don't. Maybe it's easier. Just let the nudges take care of you. These are my other favorite books in the field of behavioral finance. And I'll tell you, they're really fun. I started this journey with the middle one, Nudge, by Richard Thaler. He's the guy who won the Nobel-prize for behavioral finance. And Cass Sunstein is affiliated with both the Harvard Law School and University of Chicago Economics Department. He's a very entertaining writer, very smart man. It's a really fun book. Predictably Irrational is really fun also. He describes many interesting experiments he did, like the Economist one, and things like that. Thinking Fast and Slow by Daniel Kahneman. He's another Nobel Prize winner and an Israeli. He was at UC Berkeley for a while. It is a little bit more of a serious book, a little bit more user-friendly, but very, very interesting. There's other books in the field, but these are my three favorites. And this is good ways to find a financial advisor if you want. This is me, but I'll put it back here. And now, do we have any questions?
Can you go back to the other?
The other book? Oh, this one? Okay. Okay, this is me. That's my address. But I'm not here to solicit your business, okay? But that's me. My name is Heather Liston, and my company is Clarity Financial. So that, okay. This one I put here because a lot of people are looking for a financial advisor. These are all good ways to find them. The middle one there where it says FPA, that's the Financial Planning Association. That's the organization that provides this event together with Jonathan and the library. The FPA can help you find an advisor. The CFP site helps you find a certified financial planner. And the Garrett Network is an organization of people specifically who do fee-only planning. So they're all good ways to look for one. Do you have more questions for me?
Yeah, thank you so much, Heather. And if we have any questions from the audience, please raise your hand. My colleague will bring a microphone down so you can ask. It's important that we have the microphone so everyone on our Zoom broadcast can hear the question as well. While my colleague's heading to the first question, I'm going to ask one from the webinar. So what ways will help break through the mental blocks and aversion-like phobias linked to being risk-averse to investing, even when I have money and assets to work with? Any books and other resources to suggest, given the various psychological investment risk profiles that exist?
Yeah, that's an issue. Now, we all have feelings about risk, all of us, right? I was telling some people earlier today that I have some clients who have no money in the stock market. It's a retired couple, they have pensions, they don't need to live on their savings, and they don't need to let their savings grow. They told me they hate risk. That's okay for them. But if they didn't have enough money, I'd want them to have some in the stock market so they have some potential for growth. I work with another man who has 105% of his money in the stock market. The way he does that is he so believes in the stock market, he borrows money to invest. He can handle it. Also, neither of those clients is making an irrational decision. That the man who invests so much, he has a lot of money, he's a good job, so he can pay his bills from his current earnings. He doesn't need to live on his savings. And he doesn't have any children who are going to go hungry if he makes a bad call in the stock market. So neither of those is crazy, although they might be crazy for you. So finding your proper risk profile is a good idea. There's some tests online, by the way. Fidelity has a good one where you can fill out, answer some questions, and it will tell you, here's a suggested portfolio that makes sense for you. But if you are really afraid of risk and you feel like you should probably take some but you don't want to, what I like is to compartmentalize a little bit. Like maybe set aside a certain amount of money, and I have no idea what that amount is for you. But let's say there's $10,000 that you would be okay if you lost it. You don't want to lose it, but maybe you would be fine if you did. Maybe take that $10,000, put that in the stock market. You're not counting on it to send your kids to college. You don't need it to pay your mortgage. It's play money. Think of it as play money. Invest that in the stock market and see what happens. But segregate it so that you don't feel like I'm putting my family's future at risk. And you can think of it, I mean, many people use a philosophy like that when they go to Las Vegas, right? Some people really like to gamble. And if you really like to gamble, you may be tempted to put in more and more and more. So what those people sometimes do is you lock up your savings somewhere else, don't even take that money with you, figure out how much you can afford to lose, take it with you, gamble it, have a good time, and don't feel bad about it. So if you do that with your stock market money, you may also feel you can protect yourself a little bit from that fear. And I'll just tell you one more example. I have an old friend, very smart man. He's a law professor, and he makes a decent living and has a 401k, but his 401k, his entire life had been in cash. He was in his 50s when he talked to me. He said, I'm just really scared to invest it. But he came to me, he asked my advice. So I said, okay, here's an idea. We're not gonna change anything about the savings you already have. Leave them where they are. And he had $2 or $3 million at that point, so that was probably gonna be enough. But I said, from now on, your new contributions to your 401k, let's put that in this group of mutual funds I come up with. He called me about 6 months later and he said, Heather, I wanna buy you a car. Now, I was sort of lucky, right? Those 6 months were a good time for the market. But again, we know that over the long run, it's usually a good time for the market. The 6 months short term, I couldn't have predicted that. But the fact is, we kept his safety, his feeling of safety, by not changing anything about what he already had. And we just put the new money in, which he wasn't counting on. So segregating can help. Anything else?
We got a question.
Oh, good.
Oh, I just want the books, the 3 books.
Yeah,
You can
thank
see
you.
3 books.
These are really good books, and they're at the library if you want them.
Yeah, I'll add that those are on our recommended reading list for Financial Planning Day. You can find that on the Financial Planning Day webpage, or there's a flyer outside. You can get the URL for that.
Oh, good.
So another question from the Zoom. I guess this is calling back to something you said earlier. You gave an example at the start of your presentation that a man wanted to know everything about the market first before investing anything, sadly missing out on current gains in the process. And they wanted you to maybe elaborate on that story or the lesson to be drawn from that.
Yeah, I was thinking of a particular person, but he's not the only one. This particular man is an engineer, so he's very smart, but I think there might also be something in the engineering mindset that says, I can figure it out. And in fact, you can't figure it out, right? No matter how much education you have, we do not know what's going to happen tomorrow. But because of his profession possibly, he was used to figuring everything out. And so I wanted to convince him that it's fine to keep doing research. He enjoys doing research and he enjoys thinking about the market. But what I was trying to nudge him to do is let's get started even before you figure it out, because frankly, you're never going to figure it out. So I don't want, you've probably heard that phrase, don't let the perfect be the enemy of the good. In other words, don't wait and say, I'm not going to do anything until I know exactly how to do this. Partly because you will never know exactly how to do this. Okay? And he's not the only person like that. And a lot of people, will tell me, oh, we have this plan, we heard about this guy, we heard crypto is the thing, do we need to be in crypto? The answer is probably not, but if you want to dabble a little, it's okay. But I wouldn't spend all your time reading up on crypto. I'd get a little bit of money into normal investments and get going, and then keep studying along the way if you want to. But don't feel like you have to solve everything, because nobody ever solves everything. I hope that helps. Okay.
I think it's more a statement than a question. It's a messaging.
Okay.
You said about saving. I feel like we have not been effective in communicating that when you save, it's not just good for you, it's good for your company, it's good for your neighbor. And from an altruistic standpoint, I realize people don't like the thought of, the company forcing them or government or all that, but hello.
Yeah.
Could you imagine if we weren't dependent on the government for SNAP or for health insurance?
Yeah.
Because we actually started taking care of our future self at a young age, and hopefully our neighbors did too. And so it's kind of a messaging, I think,
Yeah.
that we could be doing a much better job so that people wouldn't be as fearful or think that they couldn't start socking money away and saving.
Yeah. One of my favorite guiding lights is Paul Wellstone, a former senator from Massachusetts, or I should say late senator from Massachusetts. He used to say, we all do better when we all do better. And I get choked up every time I say that because it's true. We all do better when we all do better. The reason that our government gives us a tax break for saving in our 401ks is because we are all better off if you're not starving to death in retirement. It's better for me if you take care of yourself. It's better for your children if you take care of yourself. It's better for your grandparents and your neighbors. And the reason we have Social Security is not just because we want you to be okay, it's because it is demoralizing for all of us to watch old people starving in the streets. And I say that because the history of Social Security is fascinating. It's not my topic today, but a lot of the way that that was explained at the time is that it is terrible for the entire society when our elderly people can't feed themselves. It's not just bad for them, it's bad for us. So I would agree. Saving is a good act for yourself. It's also an altruistic act. We need to all take care of ourselves as well as each other. Anything else?
Yeah, we have a few more questions from the webinar. So the question is, what exactly does it mean to be a rational consumer, and how can I tell if my spending habits are truly rational? And then they provide a little more context. I've noticed that giving into an impulsive desire can sometimes bring genuine joy. Yeah. Buying the cheapest option isn't always the most rational choice either, especially if it compromises quality or long-term value. But then again, I can't afford to splurge on premium items every time. So where's the line between mindful spending and indulgence?
Yeah, one of the tricky things about that is that it's different for each of us, right? What we can afford. The most important thing, I think, is to think about your own values and think about what really matters to you. And are you spending on something that really matters to you, or are you spending on crap because you just aren't thinking? Like, one thing I noticed during the pandemic, a lot of people that I work with got in the habit of sending out for takeout food for obvious reasons, right? We couldn't go to restaurants, and a lot of times we were still busy. But I have found that my clients' budgets are quite a bit higher than they were before because they got in the habit of that takeout food, and then they never switched back to going to the grocery store more and cooking more. Takeout food can be very expensive, especially if you tip well, which I hope you do, and if you live in San Francisco where taxes and everything else are high too. So I'm not saying you should never order takeout food, but I'm saying stop and think about your own values. Like, are you doing that just from inertia? Just because you started doing it and you forgot that you like to cook? Because anything that you spend money on every single month has a big effect over the long term. Another sort of fun thing I've noticed in working on client financial plans in my software over time is when people say, we want to do something big, like we really would love to remodel our bathroom or build an ADU, it's going to cost $200,000. Can we do that? It sounds like a lot of money. But what I'll find is often the answer is yes to that one big thing. Often the answer, or maybe I want to make my child a gift of $50,000 to put a down payment. Can I afford that? It sounds like a lot. But maybe, sometimes the answer is yes, you can do that. On the other hand, if someone says I spend $1,500 a month on takeout food when I really know I could be grocery shopping, that's going to have a bigger effect. That thing that you do every single month for the rest of your life ruins your financial plan much more than the one big special thing. So I would think about it that way. Have a serious talk with yourself and your family about your values. Say, what do I really value? And where am I buying stuff just because I'm in the habit of buying dumb stuff? And, is it worth maybe saving for that big trip to Antarctica and not buying a bunch of cheap clothes when the clothes I already have are fine? So there's no way to give a simple answer to that, but I would say be true to your own values. Make sure that what you're buying is what matters to you. And be aware of bad habits that you're just doing out of habit.
Got another one over here.
Mm-hmm.
Hello. I was wondering what contributes to this, like the increase, like the constant increase, or maybe the rapid increase that in the graph that you showed of the stock market.
Yeah, let's
but I feel like my real question is, what are the factors, like what are the scenarios that would have possible scenarios for us to not rely on the stock market?
I would never rely on the stock market, okay? I believe in the long-term growth of the stock market. I don't have any idea what's going to happen on Monday. Short term is a complete crapshoot. Long term is probably going to look like this. Why does it grow over time? That would probably be a good question for a macroeconomist. You know, the economy gets more productive, people make more useful things keep getting better and better over time in some ways. I don't think I exactly know why it goes up over time. But again, remember, in the short term, anything can happen. And that's why I always preach diversification. I would like to see you with some money in the stock market, but not all your money in the stock market. Is that okay or not?
I'll come down with the.
Please wait for the microphone.
I was just going to say that, or I was saying that inflation could also
Yeah, it does.
affect the upward way of the market. That's all.
Yeah, inflation has a big effect on things. And yet, real growth has also been true over the years. What else?
Okay, a couple more questions from the webinar. So you had spoken a lot about retirement planning, but we have a question for those who are already receiving their retirement funds. What suggestions could you make to wisely keep in mind when managing increases in cash and real assets?
Managing increases in cash. I'm not sure I understand.
So I think maybe when they're at a point in their life where they're reaping the benefits of planning well.
Withdrawing money.
Yeah. How to think about these principles you've been talking about in that context.
Okay. At that case, you're in the what we call the decumulation phase. You've been saving all your life, and now you're reducing your savings. And one of the things I find that happens to some people at that age is they have trouble making that transition. Some people have trouble realizing it's okay if my savings go down, right? Because we've been saving all our lives. And I think a lot of us here, including me, did not grow up well off. We were very nervous. We saved a lot of money, save. And then at some point you say, what was that all about? What was that all for? And I know I have a friend who's almost 80 years old. She loves to travel. And she said her financial advisor keeps telling her, you got to fly first class. She's pretty well off. She has a pension, which is great. Pensions are nice. Most of us don't have them. But she has a pension, and she also has a lot of savings. And she's single, and she has no children. So at a certain point, for some people, making that transition is really hard, and learning it's okay to spend. Now, for any given person, like the one who sent in that question, I don't know if that person has enough. If they don't have enough, they need to keep saving even though they're in retirement. They may need to keep being careful about their money. But for many people, if they've been saving for years, I would say sometimes one of the biggest behavioral challenges is recognizing at what point it's okay to spend. You know, you probably don't want to die with $50 million. Maybe you don't, a lot of people don't even want to die with $10. They say we want to bounce our last check. Some people want to leave a lot of money to their children, some people don't. You can think about that. But oftentimes in retirement, there is a psychological barrier to making that shift, to realizing it's okay to start taking money out. Now, if it's a serious problem, I think that person said, how do you deal with a mind shift or something? There are people who can help you. If you feel like you have a serious mental block about something, there's a whole field called financial therapy, where people can actually help you if you have some irrational problems, irrational thoughts that you're having trouble managing. There are people who can help. What else?
Thank you. Just to follow up with a specific example, building on the last question, I also noticed your name said enrolled agent. So I was curious from the tax point of view, hypothetical scenario, my mother who's now still working part-time after in her retirement age and started pulling Social Security after the age of 70, if she repatriates, let's say, the savings from a pension or an inheritance in another country, up to 100K a year, from what I heard, that's the limit, how does that affect anything from her, taxes or
International issues are complicated, and the U.S. has different treaties with different countries. So I'm afraid I'm going to deflect that and suggest that you try to find a specialist who knows about the country you're talking about. Probably wouldn't be responsible of me to try to be any more specific than that.
Okay, I think we have time for one more.
Okay.
How can family members find common ground when their spending habits and values around money differ?
Ooh, that's tricky. And I'm curious a little bit about family members. Very often it's spouses, right? If two spouses don't have the same money ideas, that can definitely cause trouble. So ideally, I would like you to have open conversations about money before you get married. It may be too late for some people, but somewhere I created the unromantic checklist. And it's my suggestion about all the things you should ask this person you've fallen in love with. Like, let me see your tax returns. Let me see your credit card statements. Let me see your health records. Before you marry someone, you really should know that stuff, especially in California, right? We're a community property state. If I marry somebody with tax problems, they're my tax problems. So that's a big deal. So ideally, you ward it off before it becomes a problem, and you maybe decide, I'm going to live in sin with this person. I can't take on these financial issues. But realistically, we all have different emotions about money. So I would say it would be really nice if you could sit down together and have a family meeting, whether it's just two spouses or whether it's more people. If you could have a family meeting and talk very openly about things, quite often that's really difficult to do. And it often helps if there's another person in the room, whether it's a financial advisor or a psychotherapist or somebody. Very often, it's just a good idea to have a facilitator there to help kind of keep everybody on track. But I would just stress openness as much as possible. In this country, I think we have a lot of secrecy about money, and it can work to our detriment. The more we can be open with people who are affected by it, the better, whatever it takes. Is that everything? Thank you. Thank you for coming.